Hello, I Anand Jain from Hanumangarh, Rajasthan welcomes you to your favorite Shridevi Classes YouTube channel where we inculcate interest and confidence in science, engineering and management subjects. Today in our subject project management in chapter financial estimate and projection, we will study working capital and financing of working capital and will understand why funds are required for day-to-day operational expenses and how we manage collection of money from accounts of receivable and manage purchases of raw material, inventory, salary heads and other expenses, and in shortfall how external financing in terms of short-term bank loans, letter of credit, invoice financing, trade credits, etc. are used for working capital financing. We'll also study merit, demerit of these financing. So let's understand working capital and its financing. Working capital is the difference of company's current assets and current liabilities. This working capital is the fund that is required to meet day-to-day operational activities of business. Working capital is required for all current operational expenses like purchase of inventory or raw materials, payment of supplier require working capital. We have to pay salary and wages to employees and contract workers on payroll. The rent, all utility charges, taxes, etc. emergency expenses comes from funds available in working capital. Working capital also covers all short-term obligations or debt of business, and efficient working capital management is very vital to avoid financial distress in any business. Determination of working capital requirements is essential in financial estimation and projection. Let's first understand the cycle of working capital. We need cash in hand to make purchases of raw material and all required inventory. And the same cash in hand as working capital is used to pay salary, wages and payroll contract staff for production activity, as well as to make purchases that are required for manufacturing supplies and our production activity produce finished goods, and those finished goods are sent to market to customer with invoice, and invoice generate some accounts which are receivable to our business, and collection of those receivable generate inflow of cash, and the same cash is used in cyclic working of business. If this inflow of working capital is managed properly, it will ensure a steady cash flow for prompt financial obligations. It will prevent cash shortage, problem of late payments, and potential disruption in our production activity or operations. Estimation of working capital for any business involve analysis of historic data available with that business, and they will tell us the pattern, variation and requirement of working capital at different positions. This estimation also require estimation of sales projection. According to that, we have to manage operational activities and can assume inflow of cash. Now this estimation of working capital basically require cash flow forecast, both of inflow of cash and outflow of cash, and proper management of inflow and outflow accurately is basically management of working capital. There are two important components of working capital. One is need of finance for purchase of raw material and inventory management, and another is fund that can be realized by account of receivables, and efficient management of these two, account of receivable and purchase of raw material and inventory management, is very crucial for efficient management of working capital. And by optimizing inventory level through technique of ABC analysis, or very popular just in time inventory control, where exact amount of inventory is procured at the time at which they are required, so that excessive investment on raw material purchase won't take place, and regular demand forecasting also reduce excessive inventory, and by that businesses can improve cash flow, reduce carrying cost and prevent obsolescence of inventory or inefficient utilization of working capital. We need cash in hand or working capital for purchase of raw material or management of inventory, and the same working capital is also required for management of production activity, for expenses on manufacturing supplies and salary and wages of daily labor. And for that, efficient management of accounts receivable is very crucial, as they will provide you inflow of cash as collection, and that could be used as working capital for day to day operations. So implementation of clear credit policies, timely invoicing to customer, and proactive collection efforts can minimize late payments, and amount received in time reduce risk of bad debts. We can also make negotiation for favorable payment terms for supplies of raw material and inventories, and this could be achieved by maintaining good relation with supplier and contractors, and that can extend payment periods and improve our cash flow and management of working capital. All businesses experience occasional, seasonal, or cyclic fluctuation in their cash flow, and shortage of working capital for day to day operation needs. Once a business determine and estimate its working capital requirement, the next step is to identify the means of finance for working capital management. Several financing options are available to support working capital requirement, such as short-term loans from banks, letter of credit issued by banks, trade credit from supplier or contractor, or bill discounting or invoice financing, or we can have working capital loans from banks. Selection of appropriate working capital financing option require a careful evaluation of each financing option, and this evaluation is based on interest rate, repayment terms, eligibility criteria, and overall cost to our business. And by comparative analysis, we can select the most appropriate mean of financing working capital for our day-to-day requirement of business. Short-term loans from bank is most common means for working capital financing. These loans of short-term obligation are most common and traditional financing option available to business for working capital needs or for management of day-to-day activity. Such short-term bank loans offer the quickest and very flexible access to funds to any business, that too at a relatively lower interest rate. Now, these rate of interest may also vary based on credit worthiness of business or collateral security, such as inventory available with business offered to the financing banks. When we provide security or collateral, most of the time financing institute banks may reduce their rate of interest, but for these short-term bank loans, there is a basic need to repay the loan amount with interest, that too in short period, and this interest payment on such loans add to overall cost of our business. Line of credit or letter of credit is a flexible financing option provided by banks. When application for such lines of credit are approved, any business can access up to a predefined amount of fund available with financial institute, but interest is charged only on the money which is utilized as working capital. So this provide flexibility and confidence in business for working capital management, and also reduce interest liability to an amount only which is utilized. But for such letter of credit or lines of credit, banks or financial institute must need some collateral or security or personal guarantees. Many a times interest rates for such flexible line of credit financing option may be slightly higher than short-term bank loans. Trade credit is an arrangement obtained by favorable negotiation with supplier who provide goods or services to a customer or buyer, and supplier extend credit to business for the purchase of goods and services. So this provide additional time so that the actual buyer or business generate revenue before payment is due. So it improves cash flow as working capital, but such trade credits may be available depending on supplier willingness and terms and condition. Many a times late or non-payment can damage such relationship. In trade credit, a business can made due payment later as per the terms of sale, and many a times business can get trade credit of 1 month 30 days, 2 months 60 days, or even 3 months 90 days. Invoice financing or factoring is another mean of financing for working capital. In invoice financing or factorizing, any business, small or medium enterprise, can sell any accounts receivable to a third party financial company at a discount. When a business organization produce an invoice for customer, a copy of that invoice is also sent to financier, and as per terms, financier can provide advances up to 90% to business organization. So business organization get immediate cash flow by converting outstanding invoice into cash, and this allow this business organization to focus on operation instead of collection efforts, which may be required to collect invoice amount from customer. Now that work would be done by financier, and when financier receive total amount from customer, he deduce his collection fee and disburse any remainder repayment for the business organization. So we have certain financier, they provide invoice financing to business organization, and this will solve working capital problem of business organization. All large industries need huge amount of working capital for its production activity, and there is a good amount of gestation period from first investment to final production or receival of cash collection for its product or services. And for such large amount of working capital requirement, specialized loans are designed by financial institute for the working capital requirement of such organization, which have relatively flexibility in terms of time for the repayments. Most of the time such working capital loans provide good amount of working capital, that too for good amount of time period, but it may demand higher interest rate or also require collateral of inventories or personal guarantees of business organization. Equity financing is used by business organization for capital requirement of fixed asset, but same equity financing can also be used to provide finance for working capital requirement, and a business organization can issue equity securities as common stock to investor or shareholder. Now when a organization issue shares and common stocks to investor, they will get inflow of cash for working capital requirement, and in the process such investment by shareholder is not a debt, and it won't have any liability of repayment of principal amount or interest, but the shareholder also got a portion in profits of the organization, and when organization generate profit, shareholder got dividend in profits, and that makes equity financing offer attractive to financer. And business organization which can produce reasonable amount of profit with reliability can issue common stock securities and get equity financing. In conclusion, we can say proper financing of working capital is essential for business functioning and growth. Effective working capital financing ensures the availability of funds when required for day-to-day activities. This enables cash flow stability and contribute to long-term success of our business. Now, continuous monitoring, regular analysis and adjustment are crucial for effective working capital management and financing. We hope this informative learning video has explained the working capital requirement of day-to-day operation of any business. We have explained working capital is required to purchase raw material, manage inventory, pay salary and wages to daily staff, and for manufacturing supplies and utilities. And if cash inflow is not sufficient, we need external financing means for working capital, and they can be short term bank loans or working capital loans from banks, or we can have letter of credit or lines of credit from bank, or we can use third party financing in terms of invoice financing or factoring, or we can use trade credits from our suppliers. Our other learning video of the same playlist are equally useful. You can use them in your studies or share them with your friends. And if you need dedicated exam centric notes from our channel, do join our YouTube membership. Happy learning. Have nice time. Thank you very much.